Most investors are preparing for the wrong crisis. They're watching the stock market, tracking interest rate decisions, waiting for the next earnings season. But the economic environment forming beneath the surface right now is not a typical downturn. It is not the kind that central banks resolve cleanly with a few rate cuts and a press conference. What is building, slowly, structurally, and with significant historical precedent, is stagflation. And if you are holding Bitcoin or gold, or thinking about it, understanding what stagflation means for both assets could be one of the most important things you do this year. Welcome back to Bitcoin Capital Gold. If you are investing in Bitcoin or gold, knowing when to scale in and when to defend your position is critical. This channel is built for investors who want clear, no-nonsense analysis to make rational, confident decisions. Consider subscribing if that sounds useful. In today's analysis, you will understand exactly what stagflation is and why it is different from every other economic environment investors are familiar with. Why the conditions forming right now in 2026 echo the most damaging economic period of the last century, what stagflation does to gold and Bitcoin separately, and most importantly, what you can do to position yourself before it fully develops. This is not a prediction of doom, it is a preparation guide. What stagflation actually is and why it is so difficult to fix. Stagflation is the combination of three things happening at the same time: stagnant or contracting economic growth, high unemployment, and rising inflation. On its own, each of those is a serious problem. Together, they create what economists describe as the worst of both worlds. And the reason stagflation is so damaging is not just what it does to the economy, it's what it does to the policy options available to fix it. In a normal recession, the playbook is clear. Growth slows, unemployment rises, central banks cut interest rates to stimulate borrowing and spending, the economy recovers. In a normal inflationary environment, the playbook is equally clear. Prices rise too fast, central banks raise rates to cool demand, inflation comes back under control. Both of those playbooks have worked repeatedly over the past 50 years. Stagflation breaks both of them simultaneously. When growth is stagnating and inflation is rising at the same time, cutting rates risks reigniting the inflation that is already damaging household finances. Raising rates risks pushing an already slowing economy into a deeper contraction. There is no clean answer. Every policy response carries a significant cost. That constraint, that absence of a good option, is precisely why stagflationary environments last longer than people expect and do more damage than the headlines initially suggest. The 1970s, what happened and why it matters now. To understand where we might be heading, it helps to understand the last time the world was here. The 1970s stagflation was the defining economic crisis of the 20th century for investors. It was triggered by two OPEC oil embargoes, 1973 U.S. support of Israel and 1979 Iranian Revolution, that sent energy prices surging and crippled production across the global economy. Manufacturing costs exploded, unemployment rose, and because wages were tied to the cost of living through union agreements, rising prices led to wage demands that led to further price increases. The wage-price spiral fed on itself. The Federal Reserve under Arthur Burns was slow to act, hesitant to raise rates aggressively into a slowing economy. That hesitancy allowed inflation to embed deeply into the economic fabric. It took Paul Volcker pushing the federal funds rate to nearly 20% in 1981 to finally break the back of that inflation. And in doing so, he caused one of the most painful recessions in modern American history. The medicine was almost as damaging as the disease. The parallels with 2026 are not identical, but they are uncomfortable. An Iran-related conflict is disrupting energy supply around the Strait of Hormuz. Oil prices have surged. Supply chain pressures, which never fully normalized after the pandemic, are being compounded by new tariffs and reshoring pressures. And, unlike the 1970s, today's governments are carrying debt levels that make an aggressive Volcker-style response essentially impossible. In the 1970s, the Federal Reserve could raise rates to 20% because the government's debt burden was manageable. Today, every significant rate increase translates into hundreds of billions of additional interest payments on debt that already consumes a significant portion of tax revenue. The Fed's hands are far less free than Volcker's were. Why this time is structurally different and potentially stickier. The 1970s stagflation was painful, but it was eventually resolvable because the structural foundations of the global economy were still relatively sound beneath the surface. Today's environment has additional layers that make the situation harder to navigate cleanly. First, inflation in 2026 is not just demand-driven, it's cost-push. When production costs rise due to energy disruption, raw material shortages, or supply chain fracture, reducing demand through rate hikes doesn't solve the problem. There are simply fewer goods available. The existing money supply chases a reduced pool of output. Prices stay elevated regardless of what the central bank does with rates. Second, the debt problem changes the policy calculus entirely. Global debt levels are at historically elevated levels. Governments can't afford prolonged periods of high interest rates without the cost of servicing their own debt becoming a fiscal emergency. This creates a quiet but powerful dynamic. Central banks feel pressure to ease even when inflation has not been fully contained. That's precisely the condition under which inflation becomes sticky, embedded, and structural rather than temporary. Economists call this financial repression, where inflation is quietly tolerated because the alternative is a sovereign debt crisis. Third, policy is always late. Central banks are reactive by design. They respond to data, not forecasts. In fast-moving conditions, that lag is expensive. Tightening continues after growth has already deteriorated. Easing begins after inflation has already embedded. In a stagflationary environment, those timing errors become more costly with each cycle. What stagflation does to gold. Gold's relationship with stagflation is the clearest of any asset class. Historically, gold thrives in stagflationary environments for one specific reason: real interest rates. Real interest rates are the return available from bonds and savings after adjusting for inflation. In stagflation, inflation is high, and central banks are constrained from raising rates sufficiently to match it. That means real interest rates are low or negative. When real rates are negative, the opportunity cost of holding gold essentially disappears. Cash and bonds are losing purchasing power in real terms. Gold, which holds its real value over time, becomes the rational choice for capital preservation. The 1970s confirmed this pattern clearly. Gold rose from approximately $35 per ounce at the start of the decade to over $800 by 1980 as stagflation embedded and the dollar lost purchasing power. Investors who held gold through that period preserved their wealth. Those who held cash or bonds watched their real returns turn deeply negative. Gold can face short-term pressure in the early stages of a stagflationary shock, particularly if the initial response is aggressive rate hikes that temporarily strengthen the dollar and make gold more expensive for international buyers. But once the rate cycle peaks and the constraint of debt sustainability forces a policy pivot, gold's environment becomes highly favorable. The current environment, with rates already under political pressure to come down and inflation remaining sticky, is forming that favorable backdrop. What stagflation does to Bitcoin, the more complex story. Bitcoin's response to stagflation is more nuanced and depends heavily on which phase of the environment you're in. In the early, acute phase, when fear spikes, liquidity tightens, and investors rush to cash, Bitcoin typically behaves like a risk asset. It sells off alongside equities. The institutional ownership of Bitcoin through ETFs and structured products has deepened its short-term correlation to broader market sentiment. When institutions face redemptions or margin calls, Bitcoin is liquid and it gets sold. That short-term dynamic is real and should not be dismissed. But that's the short-term story. The longer-term narrative is different and arguably more powerful. Bitcoin has a fixed supply of 21 million coins. No government can print more of it. No central bank can devalue it. In an environment where fiat currencies are losing purchasing power, where governments are running deficits that require monetary accommodation, and where institutional confidence in the integrity of paper money is quietly eroding, Bitcoin's fixed supply becomes a feature that is increasingly difficult to ignore. The 2026 context adds a specific dimension. The rise of Bitcoin ETFs has brought a new class of institutional holder into the market, one that views Bitcoin not as a speculative trade, but as a long-term monetary alternative. That holder base is less likely to panic sell in a short-term downturn and more likely to accumulate during the volatility that stagflation creates. Each stagflationary cycle that Bitcoin survives and recovers from adds evidence to the durability narrative that institutional allocators need to see. How to think about positioning now. Preparing for stagflation is not about predicting exactly when it arrives or how severe it becomes. It is about ensuring your portfolio is not entirely dependent on the conditions that stagflation destroys: stable growth, falling rates, and central bank credibility. The old playbook of buying dips and relying on policy support becomes less reliable in a stagflationary environment. The goal shifts from maximizing returns to protecting capital within uncertainty. Gold serves as the anchor in this environment, the asset with thousands of years of proven value preservation, no counterparty risk, and a historically confirmed ability to protect purchasing power when real interest rates are negative. It is not a growth asset in stagflation. It is capital insurance. The question is not whether to hold it, it is how much. Bitcoin serves a different role: higher volatility, higher potential upside, and a longer-term thesis that strengthens the more the fiat system comes under stress. In a stagflationary environment, Bitcoin